welcome back to this video. We're going to be talking about indicators, which are the most popular to use, how to attach them to your charts, and we'll talk about a few of these. First I'll show you on the MetaTrader 4 platform. You go into your navigator panel up here, you can find your indicators all stacked down the list there. I'll just open up a new chart, and attaching them is very easy. Depending on what you want to choose, you can put an ADX on there, just drag and drop it, choose the default settings, that's usually okay. You might want to change them, modify them, go into the properties if it's already on your chart. You can change the colours, make them a little bit, the visuals a little bit better. You can take these out. So if you're just using the ADX trend indicator, whatever your fancy is. Oscillators, popular one. This is where you'll find the RSI, Relative Strength Index. Usual parameters are okay. I just like to clarify these with big bold lines instead of broken lines. And of course you can have them just displayed on, you can have them selected on hourly time frames or all time frames. That's down to you. And that's most indicators have those kind of parameters. Stochastic oscillator, it's another good one. You might want to change these levels, but the 20 and 80 are good for the stochastic, and with the RSI 70 and 30 levels. I'll talk about these in a minute. Just get rid of these. Another one you might use is the average true range, and keep that set at 14. Keep that set there, and what this does is it measures the average true range of the movements over the last 14 candles. This will tell you how many pips you might expect on a candle's movement. It's good for take profit factors. We'll go to the other charts just now and have a chat about these. So what are the most popular ones? Well, I would say the most popular in all trading is moving averages. It's a very clear indication on the current trend and momentum of the market. We can clearly see that this is definitely an uptrend. It's signified by this 200 moving average, and you got the 50 moving average, 21 and an 8. Now what moving averages you select is completely down to you, trading style, time frames, whatnot, but moving average are a good indication on the current market cycle and direction. How you trade them is entirely up to you. There's a couple of ways. People may use a moving average cross. So when the orange line crosses through the green line, it's a buy, and when it crosses to the downside, it's a sell signal. Or you wait for bounces that come off moving averages, candlestick formations that come along there, like here, great buying opportunities. I tend not to use the cross, although it looks like it might be a viable kind of system to follow through. The problem with moving averages, like most of the other indicators, they are lagging, which mean they work off the past. Like for instance, the 200 moving average works on the past 200 candles and works out the average, and then positions it as this line and connects it to the previous candles, and you get this moving average line. But as I said, it works in the last 200 candles, which is quite a period away. And like for instance, this move here, by the time the orange line crossed through the green line, You'd already left a lot of pips on the table there, so you do actually miss, or not miss, but you don't get in early on certain moves. So although I'll have moving averages, I'll base trades on moving average bounces, or I'll have long-term trends where if the price is above I'll only buy, or if the price is below I will only sell. And a good way to spot a trending market, a sideways market with moving averages, is when everything bunches up here and all gets tied and knotted in together. You know it's a good sideways market. So a good way is start finding that trading range that the market is in between, and trade the range in a sideways market. Okay, a lot of people won't make money in here because a lot of people are buy and hold strategies, but it's very tough to utilize in forex trading because the market doesn't always trend. If you're a nimble, agile trader, you could be in and out, selling at the top, buying at the bottom, making money in this sideways market, while other people are just getting chopped up, eaten up, not making any money for weeks and weeks at a time. They only make money when it trends, but you can make money when it trends up, when it trends down, or goes sideways. That's a great thing. But moving averages are good indicators for trend strength, and looking for sideways markets. So when it gets chopped up sideways, you also want to look at the angle of the moving average. If it's up at a 45-degree angle like this one right here, that's a good indication that it's a strong uptrend. So you can always change your trading strategies to, as opposed to taking profit at a set level, go with a trailing stop method. So a trailing stop method would be if you enter the buy here, you wait for your high and then a pullback, and then you leave your stop loss below the last high. Every time it makes a new high, leave your stop there and just keep trailing it up until finally you get stopped out when the market decides to come back down a little bit. Okay, and you can gain this little insight purely from just the angle of the trend line, moving average, sorry. So they are good indicators, whereas this one, it's kind of only about 25 to 30% degrees of an angle. That's it's a weak trending market. Yes, the price will come up and test it very, very frequently, whereas this 45-degree angle, price never even touched it at all. So the price will be swinging back and forward, and of course when the moving average is flat, then we're definitely sideways and really chopping about. Just lost that one. There's another. Well, you can see that started off really steep, and you can see how it's rounding off there, rounding off. You can see that the market's slowing down, so you know something's about to change, right? And in this case, it just completely slowed down into a sideways, and then went back down the way, so just curved around. So they are good indications in the strength of the market and the current momentum. Okay, so we'll move on. On this one, this is a RSI, relative strength indicator. This measures the strength in the market, overbought and oversold conditions. Usually have it set at the default 14 periods on a close. Colours and thickness completely up to you. I like to have mine nice and thick and clear. Oversold levels are 30, overbought levels are 70. You can leave the 50 out of it. On this case, it's a default setting. This just shows a mid-range and anything above the 50 line is a long market, anything below the 50 line is a short market. So, but what you want to look out for is these conditions where it comes above the 70 level or below the 30 level. It means it's good areas for buying and selling. Now, of course, it doesn't always work, but we can see when it came up to this level in 70, you can see the market came back down a little bit, and it just creeped into the 30, so oversold area, signified by a nice spike hammer there, and continuing on up. Now, same as the stochastic, these can stay in overbought or oversold territories for quite some time. It only shows a probability that the market will turn and relieve the pressure that has been building up of the overbought or oversold conditions. So if you can match up an oversold condition, whether it be on the RSI or stochastic, I'll show you in a minute, with other factors such as support and resistance, Fibonacci's, trend lines, a confluence of instruments all pointing in the same direction as you are looking to trade, then that's one more thing on your checklist to put a check beside and make it a more confident trade. But when you go back in time, you will find out that these big areas of reversals are always in overbought or oversold conditions, and they are good areas to buy and sell. Now, although the RSI is just one single line, the stochastic indicator is based on two lines. So we have the K period and D period. Settings on this particular stochastic. What I like to use is a 14 K period, 7 slowing, 3 in a D period. Apply to close. Colours are fine, I'll use that. I take the 50 out. Don't want the 50 in there. Don't need it. And attach it there. Now, so the RSI was anything above a 70 was overbought. In this respect, on the stochastic, anything above 80 is an overbought condition. Anything below the 20 is oversold. They work in the same manner. They work in the past data on the markets and work out overbought and oversold conditions. Now, a signal from the stochastic would be a crossover in an overbought or oversold condition. A lot of people reckon that if you just traded on a stochastic on its own, then you could be profitable. I've never tried it myself, to be honest, but every time it crossed, you placed a trade, closed and then reopened the trade, and just keep doing that every time it crosses or in an extreme condition. But I use the stochastic in pretty much 95% of my trading systems. It's a really great indicator to have. Don't know what I would do without it, to be honest. So we just measure nice overbought, oversold conditions, high probability areas of a reversal, as long as you have other things tied in like we talked about, Fibonacci's, trend lines, support, resistance. You're always looking for a confluence. Great thing about the stochastic and RSI is one of the most powerful indications that they can give off. I'm not going to go into it here too much, but it's a signal about divergence. Here's a very brief description of what a divergence is. It's when the market is moving down and the indication points the other way as if it's going to go up. So there's a little error there between the indicator and the actual price action. What this might signify is price action is false and fictitious, kind of maybe made up or just overstretched a little bit. And as you can see here, the market went straight up after that. Didn't really give a great area for a candlestick formation for you to base a trade on, so it would have been kind of tricky to get in at that point. Suppose you could have bought it on a breakout of these highs. Don't know, just saying. I never caught that trade at the time, so that's a daily chart as well. So these are quite a lot of pips from the bottom to the top to that is 2,065 pips. It's quite a big deal, and if you were using a trailing stop in that respect, and trailing stop, trailing stop, trailing stop, trailing stop, trailing stop, get stopped out there. Let's just say you entered there. That's a cool 1,225. Nobody's going to say no to that, right? And I usually have the Stochastic and RSIs at the same time, and they can give roughly the same signals. That will show that it's oversold and oversold. And what's better if you have that divergence sign, if they both do it at the same time, that's extremely powerful. Let's have a look at that again. So yeah, as you can see there, so the price was moving down, making lower lows, while the indicators were making higher highs. That's signified also by the RSI. So RSI is pointing up, the Stochastic is pointing up, but the price is actually going lower. So definitely keep an eye out for this right here. This is one of the most powerful tools these indicators will give off for signals. So look up, or I'll do another video about divergence as well. So, but that's a brief description of it. You can put that to use straight away and start looking out for it. But here's a good one: Bollinger Bands. I love Bollinger Bands. They're great for. That's perfect. I was just going to talk about that right there. It's great for spotting volatility in the market. So basically what happens is when the volatility and price action increases, the Bollinger Bands expand. As you can see in this little channel here, there's no volatility, the price is moving nowhere, and then there's a breakout, bands start expanding. But the great thing is, if you have a look, get your moving averages on the chart, and you notice you're in a sideways market, put your Bollinger Bands on, you can actually spot the range. Excuse me. Like you can see here, this price actually came down and just touched the Bollinger Band and no more. And that's a great place to buy. Now, in the ranges, what the price will tend to do is it'll go from one end to the other, and it could bounce off the tops and bottoms of these, and you can get 5-6 contact points out of them and great opportunities. This one you would have placed a buy on straight away, and this has got a range of 721 pips. Now that's great, and I give you a second opportunity to get in here. If it came close to that, yeah, I'd definitely be buying. Buy that, 750 pips, cool. Price was coming back down, didn't really give us, that's not a candle formation that I use in my books, might be somewhere else, but it's not one that I use. You could probably get in on this one, an engulfing bearish candle, and then look what happened to that. But the most important thing about Bollinger Bands and what I use them for is to spot these ranges, because usually when you get a range, you get a big breakout. So so the top of the range and the bottom of the range. Now nobody knows where the price is going to go. Could go up, could go down, but the key thing to do is, if you get a breakout of this, might consider a large stop loss, but if you've got the strategy of when you sell at the top and you buy at the bottom, don't always take a profit when you reach the other side. Kind of anticipate that the price might break through on either side. So if the price makes a formation of a reversal, then yeah, definitely close the trade out. But when you see candles starting to break through the Bollinger Bands, definitely keep a hold of that trade and put a trailing stop method in play, and you would have got a nice move there. I mean, if that's a 720 pip range, you know, if you, like the candle we spoke about, if you put a sell in there and you utilise a trailing stop, so you would have got stopped out on the low of this candle, sorry, high of that candle, 1,897. So that's definitely a great move, and this is the thing to watch out for. Now, it's a daily chart, so it would have taken a long time, but look at your higher time frames. Even if you trade on a 1 hour chart, at the end of the day, go to your dailies and check the candle formations, because daily chart's going to tell you trend changes. You know, like here, bounce off support level, had a large engulfing bullish candle, and the trade was long for quite a few days after that. So keep an eye on these guys, you'll know which way to trend after. I don't use the Bollinger Bands all the time. I don't like charts to be cluttered too much. I'll just take them, attach them to the chart during relative market conditions. So if a spot that is going nowhere, not trending, I'll put the Bollinger Bands on, look out for that range. Now, another thing we're going to talk about is the K.I.S.S strategy. K.I.S.S stands for Keep It Simple, Stupid. What a lot of people like to do is they like to attach many indicators to their charts, utilising the ADX, Stochastic, RSI. You might even have another one in there. You've got Bollinger Bands, 100 period, 200 period. You've got an 8 moving average, 21 moving average, 50 moving average, 200 moving average. You've got the parabolic SAR. You've got your support and resistance lines in there. You've got your Fibonacci's. You've got your trend lines, channels. Now, how messy does this chart look? Really messy. How are you supposed to know which way to trade when you've got all this stuff going on in the chart? Look at all these lines. Man, my head would be pickled if I was told to trade in this environment. The K.I.S.S strategy, keep it simple, stupid, is just utilising a few indicators on your chart at any time. Okay, so a couple of moving averages, one stochastic or RSI, and then maybe something else. And then utilise your Fibonacci's and support and resistance levels. You know, this looks a lot clearer than the chart before, a lot simpler. Okay, so this is a lot friendlier way to trade than having all these multiple indicators on your charts. It's just so confusing. Nobody can trade this. You'll have an indicator here showing a buy, an indicator here showing a sell, and this one saying sideways, stay out. You just be getting confused. So, and I can't even make out where my moving averages are in there. So it's just too confusing. So the key is to keep it simple. Okay, just stick with about 2 or 3 indicators on your chart at one time. Okay, what I would recommend is moving average, stochastic, and then when you spot a sideways market, utilise the Bollinger Bands to find the range. Okay, so you can put those into play just now. Any other indicators we want to talk about? Maybe MACD. MACD is a good one. I'll just bring up this chart. MACD is a good indication. I use that on some. Just forget about the layout just now. So basically you can get buying signals from this. You've got the 0 line there. You can basically buy signals on when this opens up above the 0 line. You place a buy order. So let's just see what kind of levels that was at. So this candle, yeah, it was quite high up this point. Or you could base your trades on when the signal breaks away from these dashes and comes out into the open. You can base your trades on that one as well. So we'll start shorting the market right here. So you would have shorted, fair enough, that would have came up, probably took your stop loss out, but then you get the next one, that would be in here somewhere. That went down a few pips, and you close your trade out or switch the trade. So you're pretty much most of the time you're in a trade. So sell in here, close the trade, and then reopen the buy. Just working with that wave action, working with the waves. Only buy when it's below the 0 line, and only sell when it's above the 0 line. So there's always little rules to use. Yeah, you get other strange indicators that never came up. Ones like this. This is just one indicator. I don't even know how somebody can trade off of this. I don't know what it is, but yes, I guess there's some people out there who use it. I like to see candle formations. I like to see the candlesticks. So the candlesticks is the most up-to-date and non-lagging indication that you can use in your trading system. So like for instance here, this nice engulfing bearish candle signified a sell straight away on this 4-hour chart right now. The same as over here, bang, close of the hour, nice sell signal. Don't have to wait on any indicators to tell you, because it's probably going to be another 4, 8, 12 hours before you might get a stochastic crossover at that point. Let's have a little look, shall we? Stochastic, just keep that settings on. So we had that cross. Yeah, fair enough. Came into the right place, right time, which is all good. But many other indicators, and they don't always work, but candlestick formations gives you the most up-to-date price action at the time. So you can make trades just solely based on candle formations. It's what we call tactical naked trading. So naked being there'd be no indicators or anything on the charts at all. Let's get rid of these volumes. Okay, so just base your trading solely on candlesticks. So every time you get a spike or a piercing pattern, you place a buy. You wait for it to go into positive equity. When you get another formation that it looks like it's about to go the other way, you close out. You might want to switch your trade, start selling. But it's always good to have a few backup things in your favour. Support, resistance indicators. So, but you could just use candlestick formations alone, but it's always better to work with something else. You have 5 points of reference. Candlestick formation should always be at the top. Second point of reference should be support and resistance levels. Third point would be your stochastic, overbought or oversold, and whatever other points that you might have coming into that action, such as profit and loss ratios working out. Okay, so there's a few things to touch on and think about. Go and have a look at the charts and examine the indicators for yourself. Have a few strategies, kind of mess about in the demo account, find out how they work, place a few trades using the MACD. find out the range, have a look back in the history about Bollinger Band ranges. Look what happens after the range has been set, and then look at the breakout of it. Just have a little look and just trying to figure them out a little bit and see the potential of spotting these ranges on Bollinger Bands, and how you should consider trading them. Okay, so that's yeah, I think that's a wrap for indicators for now. Hope you enjoyed the video, and I'll see you on the next one. See you then.